Talk Money.
Welcome back. You're with us on Let's Talk Money, and this week, we are discussing the fundamental concept of asset allocation and why it's so critical when it comes to long-term returns from our mutual fund portfolio. Gentlemen, we've established the fact that we need to know our risk appetite, our goal, the time in the market in order to determine the right asset allocation. So that's step number one. Step number two is ki kare kaise, right? What's the approach? And here you can try and do it yourself by doing your own mix of equity and debt, or you can use the hybrid fund route. So, DP sir, what is the right approach and what would you personally follow?
No, I think personally I will follow, and what is more advisable to the people is go through hybrid fund, not hybrid, because of the simple reason. One, you have to live away from your biases at a particular time. And you are not expert on what is happening in the market, what are the macro indicators are telling you, what call to take in debt funds, in the fixed income, whether which duration you should play in the, and then more than anything else is the tax efficiency.
Okay.
Because as of the tax laws today, whatever is happening within the fund, the income generated from that is absolutely tax free for the fund. If you are doing it individually, every time you rebalance, the tax liability will trigger.
Sure.
But if the fund manager is doing it on the behalf of investor, nothing triggers. The tax liability will trigger only when he or she redeems the fund, when he's selling the fund.
Yeah.
So that's the most important thing. And it's very, very important to understand, unless and until you are fully hands-on, have the expertise thing, and you can do better than the tax efficiency part also, then you can do that, but this is extremely difficult.
Okay.
So hybrid fund is definitely the key, and that has to be there if you are doing the.
There's a query coming in on the dynamic asset allocation category. Let me quickly take this question. This is a query from Pankaj. Pankaj Katkar is asking this question, saying, how do I determine the taxation of a dynamic asset allocation fund? How would I know if it is above 65% in equity or below? And I think that's a great question, because by nature, it's a dynamic fund. It keeps shifting between debt and equity. But you get equity taxation only when the equity component is more than 65% of the corpus. Great question, and thank you for asking this. DP sir, how does it work for these funds?
See, it used to be a problem actually. I mean, maybe people are not knowing whether it is more than 60%, whether dynamic asset allocation category. But today, if you look at it, most of the funds are in the balanced advantage category. The dynamic asset allocation 2 or 3 funds used to be there, but they have also converted into balanced advantage fund, where there is a certainty to the investor that it will be more than 65% only, so they don't have to worry.
Okay, so most of the balanced advantage funds are above 65%.
And how do they play that 65%? They may not be active into the equities 65%. They can play along with the arbitrage fund, which is the active category. In the active equity category, it comes, but at the same time, it doesn't have that kind of returns, that kind of risk. So people pay 40% active equity, 35% arbitrage, or 20% arbitrage, 45% equity. The fund manager is taking a call on that.
All right, sir.
As far as dynamic asset allocation fund is fair, yes, this is a problem. And if you are into dynamic asset allocation fund, the previous month's closing, what is the average that is available on the website, you can see that.
Okay.
But
it might change the next month.
Yeah, it might change. But looking at the ease for the investor and everybody, I don't even remember there's even one dynamic asset allocation fund which is changing like this.
That rapidly.
So everybody is going into balanced advantage category, which is 65% plus only.
It gives you great equity taxation. Just to complete this topic, Feroze, since you brought up this point that a lot of young investors are coming in, and that fixed income part of their portfolio, they'll probably not touch it for a good 7, 8, 9, 10 years, right? So instead of putting money in a pure fixed income fund or leaving it in your bank deposit, if you were to play fixed income through the hybrid, more tax efficient route, then give us 2 or 3 funds, categories, I mean, at least the category prototypes that you think make great sense if you don't need that money for at least 5 years.
See, I think hybrids most of the hybrids have become tax efficient. Because like DP sir said, even the 35% equity guys get taxation of equity long term, 12.5, after 2 years. So as long as...
Within hybrids, because there's conservative hybrid, there is balanced advantage. There's so many different types of hybrid funds, right? So it's a little complex for the investor.
If you are a young viewer, be rest assured that debt is more risky in the long run than equity. Debt is the riskiest asset class where you are sure to lose. if you're going to own something for 10 years and you're sure to lose the purchasing power of your money, there are very few risks which can be near certainty. This is post-tax, you will surely not beat inflation in debt in a country like ours.
So you should not be in debt for 10 years if that's your time horizon.
Only like young people might also, like DP sir's point again, sorry, I'm reiterating, if there is a young person who wants to buy a car in 2 years, that's a separate portion of the money. That you have to be conservative. You can buy an arbitrage fund or a very conservative hybrid fund if you have 3 year plus.
Okay.
One point I'll say, in the category as you put in, there's only one category which is little tax inefficient today, which is a conservative hybrid fund.
Okay.
Because conservative hybrid fund, you are not supposed to put more than 25%. And if it is less than 35%, you get the marginal rate of tax. So that is there, but you will get the growth of 25%. So though for the people who are there in the lower tax category, who are into 20% category, who are into 10% category, which most of the retirees at the mid-level are, this is the best product for them. They're getting very less risk, but their marginal rate itself is 10%, 20%, 30%.
Right.
This is good for them.
Got it.
Okay, but for the highest the tax category people, then you have to go to either 35% category, which is all multi-asset fund, multi-asset allocation fund, or equity savings fund, or balance advantage fund, or equity hybrid fund. These are the 4 funds which come into that category, 1 year or 2 year.
Got it.
So multi-asset allocation is typically into the 2 year category. Others are equity saving, can be 1 year, can be 2 year, depending on the equity allocation. But balance advantage fund and equity hybrid are into the equity category.
They get the equity advantage, that equity taxation advantage. Okay. I think we have time to squeeze in one more viewer question. Samrat Datta, he is calling us. I think he's from Bengaluru. Samrat, welcome to the show. Tell us, how can we help you?
Hi, I'm Samrat from Bangalore, and my question is, keeping a long-term horizon of 20 years for SIP, what should be the ideal mix of the portfolio with max 4 mutual funds in it? This money can be used for building a retirement corpus. Thank you.
Okay. All right, Samrat, let me toss that to Feroze straight away. 20-year SIP money. He's saying, give me 4 funds.
See, firstly, I think if there is a retirement objective, try and marry your objective with the objective of the fund. Now, DP sir is here, and incidentally, SBI is the largest asset management company in the country, right? So, and it's the only asset management company in my model portfolio has 3 schemes. Okay, never has it happened in the last 12 years we've had it. So, leaving that apart, so like you have an SBI retirement fund. Okay, if you marry these 2 objectives, you're more or less certain that the fund manager is also looking at really long term. What is happening of late is diversified equity funds have this tendency wanting to beat their counterparts every single month. Your objective is 20 years, right? A retirement fund will not be so hell-bent on trying to beat its benchmark or its peer group every 1 month, every 2 months. So
let me actually bring that to DP sir as well, because it's a great question that if I want to build a corpus over 20 years, I can go in a diversified equity mutual fund. Then why should I look at a retirement solution fund?
See, diversity equity fund, what the Samrat's query is basically that he is putting it for 20 years. So he is going into a fund where the uniform investor base is there who are putting money for a longer period. So the fund manager's way of investing will be different from an active equity fund where he has to look for the redemption also on day-to-day basis. He has to look for the liquidity in the fund, has to look for then as Feroze said, every time there's a pressure that this quarter I have to beat not only the benchmark but the peer set also. But then the retirement fund, when you are very objective, concentrated, good businesses, good stocks, you have created a portfolio, you need not be worried about. That portfolio over the period of 3 years, 5 years, 7 years will keep on giving the very good return. But only thing, keep on reviewing the portfolio, keep on reviewing the fund's performance at least every 3 years. Don't look at it every day.
Okay.
So this is a 3-year unit. You should look at the position of the fund.
Okay, fair enough. Fair enough.
Surabhi, can I add one word of caution?
Absolutely. And the final
whenever
word.
you look at a fund which is a locked-in fund, stick to the top 2 AMCs. Because you would want to have the kind of depth in analyst which can stand the test of time.
Sure.
Like I would look at not beyond the top 3 if I'm locking in my money.
Okay, fair enough. We've run out of time, but not out of questions. But I think it's a great starting point. Asset allocation is something we need to keep in mind. We need to be disciplined in our approach and look at our goals and try and find solutions depending on the goal that we are trying to meet. Got it. Thank you so much, gentlemen, for joining in. Great to have both of you in the studio for this conversation.
Thank you so much. Thank you, Surabhi. Always a pleasure to be here.
Wonderful to have you, sir. Well, with that, it's a wrap on this edition of Let's Talk Money. Keep sending us your questions, your feedback, comments, and queries. We'll see you again next week.
Let's Talk Money